Good afternoon, everybody, and welcome to this webinar provided by the ASFP. Today, we're going to be talking about professional indemnity insurance, and we're just going to wait for a few moments while everybody registers in and arrives, and the number of attendees is still just going up slightly. And then we will make a start. Okay, so good morning, everybody, again. My name is Andrew Taylor. For those of you that don't know me, I'm the tech officer here at ASFP. We have a webinar today that's going to be presented by one of our ASFP members, one of our recent ASFP members, Consort Insurance. Consort Insurance have recently joined the ASFP as our insurance partner. Okay, and they're going to present to us today on building a professional indemnity program in today's market. The webinar that we're providing today is CPD accredited, as all of our ASFP webinars are. And to that extent, if you're watching this now live, you're one of the people that's watching this now live. If you want a CPD certificate, you can email info@asfp.org.uk to request such a certificate. The webinar is being recorded and will be made available for people to watch on Catch Up TV. But for those of you that are watching this, the recording of this, unfortunately, we can't offer CPD certificates. I'll put the email address that you need for CPD certificates into the chat box in a minute. But without further ado, I'm going to hand the floor over to our presenter for today from Consort, Daniel White. Daniel's their Consort sales director, worked in insurance for over 10 years. And for the last several years, he's been working on the fire sector, dealing with a variety of clients in obviously the complex insurance market that the fire protection sector is. So Daniel's going to give us this presentation today, and I'm going to now hand the floor to Daniel. I hope he's going to appear on the screen in front of me. There you go, and I'll hand the floor over to Daniel. The floor is yours. I'll hand it to you, and I will see you all for the questions and answers at the end.
Brilliant. Thank you, Andrew. So Andrew said, yes, my name is Daniel White. I'm the sales director at Consort Insurance. This is the first webinar that we've actually held with the ASFP since joining them as their insurance partner. We hold a number of these webinars really the last few years with a number of different associations and for our clients and generally the sector to try and provide some education, try and clear up some misconceptions generally. And the hottest topic for them all at the moment is PI. Has been for some time, probably will be for some time longer. But so for a rough agenda today, here's what we plan to go through. So first and foremost, just to put us all on the same page, understanding what the professional indemnity policy is and how we've arrived to today's market conditions is always a good starting point for us. Then also moving on to demonstrating how limits of indemnity can be supplied by insurer and how that's changed in recent times and might well be changing in the near future too. Moving on to explaining the claims made basis. It's a crucially important part of the PI policy. It's drastically different to other parts of the programme. And then also touching upon why it's really important to understand how that affects your contractual obligations. And then some considerations for a professional indemnity policy. Policies are changing year on year, so I pulled out a few of those for us to discuss, as well as some wider points about things that might not seem obvious to think about. And then lastly, how to build a comprehensive information set. So, you know, the market is, will always need proposal forms, but what more can we do to make sure that you get the most out of the exercise? So what is professional indemnity? We'll start with identifying it in the most broad sense possible. In most cases, PI is a standalone policy, but it can also be found as a subsection in an insurance program. But regardless of the placement, it covers you the legal costs and expenses incurred in your defence, as well as any costs that may be awarded if you're alleged to have provided inadequate advice, services, or designs that cause your client to lose money. So when a business purchases a professional indemnity policy, you're purchasing a contract that guarantees, and a really important word, guarantees insurers will pay out in the event of a set of circumstances occurring. Now, these set of circumstances occurring are not just the claim event itself. For the cover to be granted, a policyholder has to have acted in the correct way after the loss arises, and that's what we refer to as claims conditions. So, you know, an incident could trigger the professional indemnity policy perfectly. So it's visible the policyholder made an error in their professional responsibility. That causes a customer or a claimant financial loss. But if they have not acted correctly following the loss, cover may be rejected. So, as I'm sure you're all now aware, we are in the midst of a hard market. So generally that means insurers are less willing or able to provide terms because insurers have to purchase their own insurance, which is called reinsurance, and their reinsurance treaties stop them from being able to write certain lines of business. And that means that those insurers that remain have generally, in recent times, pushed for quite significant rate increases to stay on cover. The reason for the hard market is a topic of conversation itself, so I'll be touching upon that here. So, like many industries or marketplaces, the UK insurance market really moves around in cycles. And since the last hard market we had in the early 2000s, the UK has traditionally been seen as a really buoyant investment opportunity. So typically that means foreign investors providing the capacity, providing the money to insurers to write business. And breaking that idea down a bit more as to why the investors have seen the UK as a good investment. There are a number of reasons, but there are two predominant significant factors. The first of those factors is the lack of significant natural disasters. You know, we don't have terrible hurricanes, seriously severe flooding. And the second item there is the litigious nature of our society. You know, we aren't all suing everyone like they are in America, although you could argue that we're slowly going that way. And we also then don't suffer those natural disasters to the same extent that America do. When you compare that with similar economies, it makes us more appealing to invest in for an insurer. Something else that we also need to factor in at this point as well, and it's really topical, to be honest, is inflation and how that impacts insurers' claims values. Because obviously 5 years ago, an insurer wouldn't know inflation would sit at 10, 11, 12% today. So that really puts a lot of stress on the claims reserves for insurers and then starts to affect the premiums that can be achieved. So, so the market enjoyed the benefits really of insurers fighting on premium to win business, and the negative effects of that are really only seen in the long term. So as for why the market is now hardened again, that's down to a number of factors, but essentially, obviously, claims start to materialize over the course of time. We also see things like legislation changes. There's something that came into force a couple of years ago now called the Ogden Act, which affected how compensation is provided for claims. And then we also have significant events. And for a large, the main event that's relevant, especially to this industry, is the tragedy that was Grenfell. A combination of all of these types of events really means that insurers withdrew entirely from the market, or their rating structures increased so dramatically that, in theory, they withdrew themselves from the market too. And the ones that remained were really left to write all of the business that was there to write. So, professional indemnity limits. I painted a fair bit of doom and gloom on the previous slide, and I'll attempt to lighten the message. But unfortunately, we still are in the harder market. And whilst we're not seeing some of the challenges we had before necessarily in terms of really significant premium structures, premium rating structures increasing, we still do have some significant challenges. When considering the effects to PI specifically, some of the most drastic changes in recent times has been around the premium inflations and sometimes dilutions of cover, but also changes as to how PI programs need to be built, and most importantly, how limits of indemnity under policy can be supplied by the insurer. So, historically, a business that wanted to purchase a 5 million limit would quite likely been able to approach one insurer to supply that total limit. As a result of that hardening market, the insurer appetite reducing, many exiting the market, insurers that are left are remaining there and wanting to spread their own risk. And that means a more strategic approach is required to build a decent and a good level of cover in a PI tower. So on the left is the traditional placement, and on the right is the new style that we need to be considering. So this type of approach is becoming more common now, particularly where a business completes those works that insurers are somewhat uncomfortable in writing. So a program is typically seen like this: 3 insurers supplying the total 5 million required. This approach might not seem that unusual to some of you because you may have been through a renewal cycle in recent times where that's happened. But there is an element to this that is absolutely crucial. So if insurer A, B, and C are all approached to be a primary insurer, to be the first insurer on that slot there at 1 million, it's likely that you'll collect declines to quote from insurers B and C, because it's really important to understand which insurers have appetite for which part of the PI build. And in this instance, insurer A would have the most appetite. So it's important that your broker understands what you're doing, what the insurer appetite is, and approaching the insurer for the right level of cover. Because once you've secured insurer A as your primary insurer, that's a lot of the hard work done in terms of finding the appetite. Insurer B will have comfort that insurer A is the primary insurer. They understand how that insurer works, they understand your risk, so they're willing to enter the build at that point. And then we have insurer C, much the same as insurer B, happy to follow. This type of build, we see these up to 20, 50 million towers with a significant number of insurers. And this strategic approach is really key. So if your broker is aware of what you do and the insurer appetite, then they should be building this for you. So moving on to the limits and how they can be varied and applied to the policy. So traditionally, the limit of indemnity has largely been enforced as an any one claim limit. So if we imagine a business purchases a 5 million limit indemnity on an any one claim, this means the business will be covered for an unlimited amount of claims. Touch wood, doesn't happen, but unlimited amount of claims up to that value of 5 million. And I will touch upon this more during this presentation, but as a result of this being the norm, nearly all businesses now have committed to contractual obligations to purchase PI on this basis. And so what's pretty standard now in the market, and certainly just a lot more common for businesses to have to take on, is a 5 million total aggregate limit. An aggregate meaning the 5 million total, you're covered up to the point that that limit is exhausted, and that's regardless as to how many claims are made. They're very different to any one claim. So in the instance that a business has to move from any one claim to aggregate, it can cause issues around those contractual requirements mentioned previously. And I will touch upon this again soon, but there are some routes that are available that are better helping you to cover that exposure, and that's including reinstatement on a policy. So reinstatement essentially means that insurers will accept the policy limit to be reinstated once the total policy professional indemnity limit has been reached in exchange for additional premium. So not every insurer is willing to offer reinstatement, I should add at this point, but those that do will charge an additional premium at inception to have the possibility of that. And that generally, that's about 20 to 30% more on premium. And that's on top of the additional premium you need to spend if that limit does get exhausted in a claim event. So generally speaking, an insurer would be agreeable to allow reinstatement, but as you might imagine, they need to see quite a significant build tower to enable that. And generally speaking, it would be a minimum of a 10 million limit in force. And that limit needs to stay in force throughout to allow the reinstatements to occur too. Reinstatements can be applied as a single reinstatement. So we'll go through once and we'll go through again during the policy period, and then unlimited reinstatement. Obviously, unlimited costs more in premium, but those are some options you can explore. The shift in limits from any one claim to aggregate really should be made hopefully abundantly clear from your broker, and should be made obvious during any early renewal negotiations, because when an insurer changes their appetite so significantly as that, brokers are informed in good time to make sure that their clients can start to make some either adjustments to the program in the market, or start to review their own contractual requirements with a legal team, preferably, to see if there's some opportunity for flexibility there. So a professional indemnity claims basis. So it's really important to understand claims made, because it's just so different to other policies and how they work in the market. So it means claims made means it covers claims that are made and reported during the policy period only, and not once the policy period is over. Your previous insurer will no longer accept the claim if you have moved provider. Sorry, excuse me. So as long as your brokers endorse your policy with the correct retroactive date, that enables you the best opportunity to have cover confirmed, but you still have to notify your current insurer as soon as you become aware. So I'll take this timeline below to try and demonstrate that. On the 1st of June 2019, you complete works for a contract whilst insurer A is on cover. However, the claims incident has not come to light until the 1st of June 2020. And by this time, you've moved your insurance to insurer B, and that means insurer B will respond to the incident and handle that accordingly for you. Oh, sorry, I clicked too far there. So, and that's an entirely different type of claims basis to employer's liability, for example. So using that timeline there, employer's liability, on the 1st of June 2019, some employee broke the leg, and then a year later, that person makes the claim. It's the insurer A there that responds, whereas professional indemnity, the insurer that you're with at the time of the notification. So I mentioned retroactive date there, and this is the date that will be shown very clearly on your schedule, and in most instances, it should reflect the first time the business purchased a PI policy, because it enables you that cover back to that date. There are some circumstances where this might be a separate date, such as the acquisition date for a business that's been bought in. Quite often we'll see schedules actually listing retroactive date as none, which can be both misleading, but it also can be a benefit to cover. Because when none is applied, it could mean, and should mean, that cover is in force indefinitely, but it means your broker has to have agreed that and negotiated that with your insurer. But it could also mean that your broker has not advised the insurer adequately about the first time that you purchased that policy. So in the event of a claim, it then brings about some questions as to what type of retroactive date is being applied. So always be mindful of that. If none is on there, make sure your broker has negotiated that and just not forgotten to tell the insurer about your retroactive date. It's a really simple element of cover, and to be honest, more of a clerical item for a broker to address. It doesn't affect your premium applying a retroactive date, even though it's obviously enabling you for cover further back. So really something to be super mindful of. So aside from the importance of understanding generally how PI works and why that's different, it's really crucial to understand the impact that this has for your business on contractual requirements. So upon any contract where a PI limit is stipulated, not only is a business then contractually required to purchase that limit, and without significant exclusions, I should add there, the contract will also state how long this limit needs to be purchased for after completion of the contract. And generally speaking, that would be at least 10, but probably 12 years. So it's important to acknowledge that, because if you're tendering for a contract that may only be 6 months, but you have to up your PI limit as a result of those requirements, should be mindful that you still need to carry this cover for many years to come. So factoring in some attempted costs would be a wise addition. It's also important to acknowledge that the handling of an insurance program within a business can move hands. And sometimes when it moves hands, people like to have an impact as to how they manage that. An impact could be lifting covers to a different level. It could be reducing premium. So if a business at any one point in time reviews its contractual obligations that are current, it might think, I don't need this PI limit. It's costing us X amount per year. We can drop down to what we've got at the moment. Well, actually, that's not accurate. There could have been contracts from 6 years ago that the business needs to adhere to. So something to be mindful of if the insurance changes hand in the business, that the person is aware of all the contractual obligations that business is historically bound to up to the point that those. So considerations for professional indemnity. Really, these are some small snippets of information about PI policies that we just think should be talked about a bit more often. I've labelled this evolving exclusions because, as I mentioned previously, with the harder markets, we see insurers' appetite reducing. Insurers go about this actually by placing exclusions onto their policy, which effectively can remove some of the cover, most of the cover. And when it's most of the cover, it should prompt the client to move elsewhere. And it obviously relies on the broker being proactive, making clients aware of those types of changes. But here's a very real example of how an insurer that was traditionally writing business for the sector changed year on year. So I'll just read from the slide there. Any claims, losses, liability costs, expenses, or defence costs, directly or indirectly arising out of, connected to the fire resistant and/or fire retardant characteristics of external cladding systems. So this policy obviously would not have been fit for purpose for anyone working with cladding systems. Just wouldn't be the right place. Shouldn't place a policy there, and hopefully any good broker would not. Moving on to the next year, this is how their policy exclusion widened significantly. And I is obviously the same as above. II and III there are different. So any internal fire protection system, any aspect of the fire safety or fire performance of a building or structure. So really, that's a massive expansion on an exclusion. So the insurer might still put forward renewal terms and might still charge a rating increase despite this massive dilution of cover. So just something to be mindful of. And another point on this, really, we speak to businesses all the time who say we've been with the insurer for a long time, we've got a great relationship, they understand what we do. And I do get that, and those relationships do exist, and they're important to foster. But something to be mindful of is things like this can change, and sometimes they aren't made clear enough. So next section here, amendments to cover. In all reality, actually, this is probably still evolving exclusions in some ways, in some truth. So one of the ways in which some insurers, and one in particular, I won't name, has remained in the market is to continue to quite drastically alter cover. So rectification costs only, which essentially means it's excluding consequential loss. So this is also referred to in different names, and as an industry, we're terrible for labeling things in different names, or also referred to as mitigation of damages. So rectification coverage, which is the cover that's been offered here, which should be part of a good PI policy, and provides first-party insurance for the cost a contractor incurs in correcting a design that is discovered after the construction is put in place, but before it actually results in a professional liability claim. So that level of cover traditionally would be supported with consequential loss, which refers to damages or financial losses which your client could suffer directly due to your mistake in providing a service or advice. So I'll give you an example of that. Apologies, a bit of a layman's example, but you could design, the fire alarm system as part of your works to be installed for a client on a new premises, but a mistake in that means that mistake becomes clear before an event, as in the fire alarm didn't work or the fire alarm wasn't suitable for the space. So the site then needs to be closed, or the opening needs to be put back. Whilst it's being corrected, means that business won't be making some money in that period of time. That profit loss incurred by your client is then a consequential loss. Your insurance policy, if you had this insurance policy, would cover you a claim for your fees as a professional to rectify it, but it wouldn't cover you for any profit loss claims against you. Sorry. So quite a serious one, that one, really, and something that certainly sneaks onto policies more often than we'd like. And here's just a couple more, really. So two typical exclusions we see now on PI policies: removal of cover for injury, removal of cover for property damage. There's absolutely forms of cover within a wider program for these elements. By the way, we're talking about liability policies here, but we didn't used to see these types of exclusions on policies, whereas we do now. So it's just a tightening of the belts from insurers that really I'm not comfortable with, and any broker shouldn't be, and should be pointing out exactly what that means in your program. So some more considerations here, and really some options to try and negotiate with an insurer. So it might seem obvious, but really they should be reviewed as quickly as they can. And the first one there is excess levels. They can typically vary from insurer to insurer, but it's also really worth exploring if your insurer is putting forward a premium increase. how much or can that increase be negated with an increased excess if you're comfortable in carrying that extra level of risk. So in some smaller PI policies, insurers can be flexible for this, and typically an increased excess, from 5,000 to 10,000, we'd probably see about a 5 to 10% reduction in premium. So on probably the flip side of that, where we've got quite a heavy PI program, we're talking probably 15, 20, maybe in excess of that million limit. Substantial excess levels we're applying, we're talking 25,000, 50,000, maybe 75,000. A good negotiation point really is to see if the insurer is willing to cap how many times. And apologise for that icon, it's a bit cheesy, but couldn't quite find one to match perfectly for it. But to see if the insurer would be willing to cap how many times that could be paid in one period. So, for example, a maximum 3 times we would pay for the excess during the 12 months. Now, obviously, touch wood, having more than 3 PI claims in any one period is far from ideal and relatively unheard of. But the worst things, more unlikely things have happened. But bringing that discussion to the table early on during the renewal process at least helps to prepare for a worst case scenario. So, novation of contract. This is actually a huge subject and something that we try to talk about as often as we can. So I'll just read from the slide here because it's better language than I could put forward, really. So, a contract which extinguishes a contract and replaces it with another contract in which a third party takes up the rights and obligations which duplicate those from one of those original parties to the agreement. So I'll use a practical example for that. Your business is brought in halfway through the completion of works to replace a contractor because they were removed and/or were unable to complete the work required. So that might seem like a fairly innocuous event because you're just going to be going on site, completing the works exactly as you would because you're used to doing those. However, it's really, really important to let the insurer know that you'll be doing that and that event is due to take place, not after the event. Because an insurer needs to know what the contract is and what works have taken place to date, what works have taken place in the future, where's the handover point, any rectification works, if you're correcting any of the previous contractor's works, essentially chapter and verse. And the reason behind that really is relatively simple. Insurers need to have the comfort that they aren't taking on the responsibility of insuring works for the previous contractor. And given the scenario of novation usually transpires when one of the original parties in the contract isn't happy or not meeting the obligation or not good enough standard of work, it leaves a more probable risk of an incident occurring. So something to bear in mind, if you're taking a contract halfway through, speak to your broker, speak to your insurer first, make sure you understand exactly where you're taking on from what point of work, and the insurer understands that as well, because if a claim arises, an insurer has to identify at which point they're responsible, as in yourself, is responsible to then take the claim on. Because what they won't do is say, right, okay, we'll pay the claim. Those works were related to a different contractor that we don't insure because they aren't the financial compensators for that insurer, for that client. So, market exercise. Now, they come around every year, and really the first point I'd say is start earlier than you might think. If you're not in regular contact with your broker, then ask to meet at least 3 months prior. That's giving yourself the maximum possible time to try and collect the information you need to build that comprehensive information set. There are less underwriters than normal because of that reducing capacity, as in physically less underwriters in the country able to write the business. So each of those are stretched capacity-wise because they're writing more business than before. So being in early gives you that advantage. There's also the consideration, if you're quite late to the process with an insurer, you've got much less opportunity to negotiate, your buying power is reduced, so earlier the better is the advice there. Proposal form, they aren't going anywhere. Clients don't like them, we're not particularly fond of them, and I'm not even sure the insurers like them, but they are a necessary evil. Completing a proposal form should be a back and forth process with your broker. They should be challenging you to expand on certain areas. Because, and I'll touch upon this throughout this slide really, what we need to do is avoid grey areas for an insurer. So complete a good proposal form, a good standard proposal form. If your broker passes you a 3-page proposal form, that might seem like a good result because it's less form to complete. It's not a good result in the market. Not a good result at all. So making sure your broker's identified the right proposal form for you. So turnover review. Proposal forms do collect turnover, of course they do, but sometimes it just feels a bit like square peg, round hole. So think about identifying your turnover in as clear a format as possible, as in pull that out of the proposal form, create a separate document. What works are you doing quite specifically? You know, are they in-store, are they maintenance, are they supply only? How does that compare? And then obviously, where are you doing these types of works in respect of location type? Breaking all that down in as many different ways so an underwriter can take a look at one page and say, right, I understand what they're doing and where they're doing it and how they're doing it. And then proposal glossary. So, you know, us as an industry, an insurance industry, we're terrible for this, but using technical language or even very simple language, to be honest, can be misleading for an underwriter. Not purposefully so, but if we imagine an underwriter has to write types of policies for a variety of industries, but you know, even within the fire sector, there's lots of different types of technical language they need to learn. If you reference a certain type of works, consider that putting that out for a discussion in the supporting document. So, you know, what exactly do you mean by X, Y, Z? Relate that back to a set of works, because it's just as important to identify what you aren't doing work-wise that an underwriter might wrongly assume you are doing. And if they wrongly assume something and it's not in their appetite, they'll then collect a no quote from an underwriter that could have been able to provide terms. So that kind of thing, certainly give that some consideration. Company structure. So really important, this one. Who's in the business? How long have they been in the business for? What's the progression path for some of the key staff? What's the succession planning? All of that's important for insurers to understand your business properly. And you know, all of this is trying to make an insurer feel comfortable and put your submission at the top of the pile. Succession planning is a huge one. Because professional indemnity, you need to carry that for 12 years after completion of the contract. What happens if someone, a senior member of staff, moves on to a new business or is planning to retire in 5 years? How can we give the insurer comfort that that knowledge, that expertise remains in the business to be used moving forward? So a company structure chart is great. Think about expanding the problem a bit more and make that some supporting evidence for your proposal. So competency validation. So training, really, you know, so internal training to formal training. How's that managed? Who's it managed by? What accreditations the business have? And really, most importantly, with accreditations is when was the last time these were audited and what were the results? You know, if you've got some really fantastic accreditations of business and you're flying through the audits as and when they happen, tell the insurer about it, because you know that makes you a more appealing prospect for them. And then training records, how are they kept? Your CPD, you know, how much of that of your team complete each year? Where's that recorded? Provide that as an additional document to insurer to say, these are how I'm keeping my team up to date with the Building Safety Act. This is how my team is responding to all these different types of changes in legislation because we're doing CPD. Again, sounds like obvious stuff, but if you've got that information in the business available, then certainly share it with your insurer. Bona fide subcontractors. So insurers absolutely understand and accept that bona fide subcontractors are necessary for your business operations, because they're out there completing works that are very specific. They're the specialists, or they're supporting you on a contract where you need more hands to do that, but you're giving some more free rein. But what's most important here is about the due diligence that takes place. So how do you find them? How do you vet them? How do you interview them? You won't be checking their work on a regular basis, but when you first start working with them, how do you know their standards where it needs to be? All of those things are important, because in the event of a claim, an insurer will pass on the claim to a bona fide subcontractor, because that's exactly what they are. But who knows when a claim happens, whose fault it is immediately? Your insurer still might need to respond with your defence, which means legal costs, which means incurring costs for the insurer. So they need to have comfort that you're making the necessary steps to make sure that they're appropriate to work with the business, making sure that they have the correct insurance requirements, all of those kind of things. So it sounds like an obvious thing. Do you work with subcontractors? A proposal form say yes. Next question will be, do you check their insurance place? They say yes, then they move on. But actually, you can be stronger on that to help an insurer understand that your business goes the extra mile. And then it's this point, and only really at this point, you should go out to market. traditionally a market exercise would have been just a proposal form. So you can see how all of this type of additional information, which in some instances for some businesses really is only tip of the iceberg, but how this all starts to mount up and makes a really compelling proposition for an insurer at a time when the market needs to be sold on insuring a business. So that brings us to the summary really, but I'll just run through the items that we've gone through there. So understanding what the professional indemnity policy is, we went through that, how we've arrived at today's market conditions, what makes a harder market, demonstrating how limits of indemnity can be supplied by an insurer, varying at the moment, and we might see changes again in the future. The third there, explaining the claims made basis, why that's really crucial, how that affects your contractual obligations, and then considerations for your professional indemnity policy, things that change year on year, little tweaks, keep being mindful of those, certain bits in the policies that can catch you out, and then building comprehensive information sets. So yeah, that brings us to the end there really. Welcome to any questions you've got. If there's anything particular that I picked up there, if there's anything wider on PI, by all means, please do let me know, and I'm happy to answer what I can.
Okay, so we've got, okay, Daniel, thank you very much for that. There's one question that's a couple of these questions have just started to come in. The first question says, for a claim to be made against either a subcontractor or a manufacturer, does there have to be a written contract in force which specifically states that you have design responsibility? And related, do you have to be paid for design to have design responsibility?
Okay, so that's quite a loaded question there, really, trying to pick that apart. In terms of written contracts between two parties, you could be taken to court without a contract, I'm sure. Specifically states that you have design responsibility. So no, there wouldn't need to be a contract that specifically states you've got design responsibility to make a claim against a third party. Advice on site can be implied. You can be on site and suggest something that results in a claim. That wasn't written in the contract, that would be happening. So I'd suggest that a written contract is certainly preferable, because an insurer will reinforce your written contract in the event that you need to pass on a claim. So they're absolutely preferable, by the way. But I'd say that there doesn't have to be a written contract to mean that you're taking on design or advice responsibility. And then related, do you have to be paid for design to have design responsibility? There has to be some element of fee being paid between two parties to then take some responsibility, because someone's relying on your professional judgment, use your services. As to whether they're accepting specific fees into design, not necessarily. It really depends on the situation between the contractor and the design. When you're involving a manufacturer, as we are in this question, that also brings about something that's quite different, because we might be tipping into a different element of cover within a program. We might be moving more into liability outside of PI. So a few different answers for you there, but certainly written contracts between parties always preferable, because insurer will always try and reinforce what limits have been applied within those contracts. And you wouldn't necessarily have to be paid just for designs to have a claim against you in respect of a design responsibility, because we just don't know what happens when a claim, we don't know what a third party is going to allege in a claim scenario, because the lawyers and solicitors and those and third party insurers involved will often try to claim as much as they can in many different ways. So I'd suggest, hopefully somewhat of an answer for you there.
And just from while I'm thinking of that, how when we're talking about professional indemnity for design activity, where would you take your definition of design from CDM?
We'd rely, well, possibly. I mean, it's such a broad. We'd have to look into policy wordings for one. We'd have to review what the insurer considers as design, and then we have to consider that each insurer might consider that separately. It wouldn't be for us to suggest what the insurer would consider design, but yeah, I mean, it certainly makes sense if we're providing very specific design plans to a third party, then obviously that falls into there. But professional indemnity, it's wider than design. It's advice and design. So if you're providing ad hoc advice to someone, as well as design alongside it, a claim could come in for the advice that you provided as well. So it's being mindful that a claim can have so many options to a wide variety of possibilities that it wouldn't necessarily just fall under designs that you've offered a third party.
And because the reason I said that was I was going back to the presentation that Kate gave us when we were all, those of us that were at Aviva, I know you were there, when Richard Harrell came, because we were talking about what constitutes design in that context, and there's an awful lot of design there's an awful lot of advice that people give that may not, you may not be construing as design, but in actual fact under CDM it comes within scope of design. Okay. There's another question appeared asking if it's advisable to go with just one broker or whether we should consider multiple brokers at the same time.
Yeah. So it's difficult at this point, really, these questions, because we have this question, it sounds like there might be some self-interest coming into this answer, but there's absolutely not. So when we're in the market that we are, where the insurer appetite is reducing, we've got not many insurers available to offer us terms. Multiple brokers in a tender scenario is not necessarily a good thing at all, because the consideration we have to think about is, are the brokers going to collect all the information in the same way? Because it's their responsibility to extract that from a third party. Are they going to collect that in the same way? Are they going to present that in the same way to an insurer? And then if an insurer is presented with business ABC, two conflicting information sets, that then results in that insurer being less inclined to put forward terms. The insurer sees that the business is, and then also, because they're so stretched capacity-wise, they then are less inclined to try and put forward terms. So I would say in the event of any tender exercise, if you are going to go with multiple brokers, take your holding and one other broker that you can quite specifically be comfortable that they will approach the insurers. And then when you're going through a tender exercise, you need to be clear about a marketing strategy of both brokers. Okay, broker A, who would you like to approach? Broker B, who would you like to approach? Is there an overlap? If there's an overlap, how are you going to tackle that? Because the last thing you need to do or should do would be approaching the same insurer, turning down a market that might have been able to offer you terms, and then sadly being potentially without terms you could have achieved in the general marketplace.
Okay, it was very interesting that you suggested that we end up with a policy that covers where the risk is held by multiple insurance companies. So are you saying that's how we would come to one broker, and one broker would organise that multi-layered approach?
Yeah, exactly that. Yeah, exactly that. Provided the broker understands the market well enough to build that program that way, then absolutely. I mean, tender exercises happen all the time. You know, we're obviously part of them, and they're our clients. We're part of the third party. But yeah, it's just got to be a careful process of building the right covers in the right place, the right markets, approaching them in the right way. So I would say approach any competitive tender exercise with as much care as you can, and have some clear strategy that the broker understands what they're doing. Because what we've seen and what we see a lot too much of still is a broker that thinks an expansive market exercise is the answer. You know, oh no, we work with every insurer in the country, we'll find you terms. They collect the information in a good format, but relatively generic, and then they'll send it out to all of their markets because they're the biggest broker and access XYZ, and the outcome is entirely the opposite of what they're trying to achieve. So, yeah, approach it carefully, but a good broker should be able to identify which markets they'll approach for which types of cover.
Okay, right. It is very interesting, because I know, but my personal experience in this is that there are times when I'm not entirely sure that that the broker fully understands what we do and how we go about to live, thrive, and survive. There's another question just come in. What are your thoughts about consultants effectively self-insuring in the absence of being able to get acceptable PI cover? Is this sustainable or even possible?
I mean, I work in insurance, so I'm obviously incredibly risk averse, really. So I do understand the challenges on premium, the challenges on finding the cover. The idea of self-insuring, are you retaining some of your income in case a claim comes in? Are you're just not buying insurance? I think there's probably considerations there that there are historical. I think back to there about legacy contractual requirements. At that point, it's then going to notify your previous contracts that you haven't got cover in case they make a claim, and which would be somewhat terrifying to do, I suppose. But if you extend, and one of the most important things generally in these contract terms when you have challenges in trying to find suitable cover, is that there will be a clause about what's commercially reasonable, or commercially sustainable. That kind of clause. It might be used to purchase 5 million, and purchasing 5 million now is just much too expensive. But you can find 1 million at still a high cost, but something that is more reasonable. I would say that might be a more suitable suggestion than going self-insuring, because in the event that you've got contracts from 6 years ago, contracts from 6 months ago, one or two of those make a claim in the 12-month period, it could be on for a pretty substantial loss. And it's not just about the cost of it, because you'd have to find legal costs on your behalf and swiftly have to do that. It would be around the time and effort it takes to then defend yourself and find the support that you need. Insurers are good at what they do. They've got the likes of typical insurers in this space, although not so much anymore. Hiscox have their own legal teams for a reason. They have the teams to defend a claim. They can. These are long tail claims generally when it happens, but they defend the claim throughout. The legal costs to be self-insured if in the event you had a claim, I think, would be pretty horrendous. So I would suggest it's not sustainable. I think the market should be able to find a response for you in terms of cover. As and when the market softens, because we will get there. As and when the market softens, there's certainly going to be some opportunities for cover. Again, when they start to understand and how the legislation changes, insurers then have more appetite. So I would say it shouldn't be possible. You can go uninsured. I wouldn't recommend it. But if you were to, it would be important probably to address that with your clients directly, because in the event that you're breaking contractual obligations and you're aware of it, it then leaves you probably in a pretty tricky position to defend any sort of claim.
Okay. All right. Hopefully that's answered that one. There's a question just been asked, a technical thing. Are we going to upload the video recording of this to YouTube or similar? Yeah, yes, we are. It'll be available, I would guess, through the ASFP website at some point in the near future. We'll upload a copy to that, and we will. I think we normally ping out a link to everyone that's registered for this to say here's a chance to watch it on catch up. So there will be a chance for those of you, if you've had connection issues, to be able to watch this again. Yes. Okay. And for those of you who if you wish to talk further with Consort of this, Consort are going to be attending our awards dinner on the evening of the 25th, and I'm sure that if you catch them early enough in the evening, they may well be willing to have a conversation with you, but don't wait till the last thing at night, please. Okay, so they'll be there. Are you doing any of the other events with? Will you be around London?
So some regional events. I'll be because I'm Consort. We're based in Essex, but we cover national. I happen to live in Leeds. I'll be at the regional event in Leeds in March.
We're next at London Build, which actually is next week.
Yeah, we've got a colleague attending there too. Actually, she'll just be attending the event. So if anyone would like to speak to anyone at Consort, will be there too. We'll be at Fire Safety Show delivering a talk with you guys next year on this same subject. Hopefully, some updates in the market by that point. And there will also be a FireX too. So we are hopefully all the places you expect to see us. Any questions, by all means, let us know, and we'd always be happy to help.
Okay. And at that stage, at the moment, I'm just wait for 30 seconds to see if there's any more people hammering away at questions and are trying to send us questions, but I'm not seeing any more open questions. So he says it's 10 to 12. Yep, you are. There you go. What I'd say to you is, thanks everybody for attending. Daniel, thank you very much for your time and giving the presentation. Yeah, hope people have found it useful, and please be in touch with Daniel and Ella at Consort. It's Ella that's going to be at London Build with us next week. And with that, I'll bring the webinar to a close, and I hope to see, if I don't see you at London Build or at next week or the awards dinner the week after, I'll see you at some point soon. It's too early to still too early to say Merry Christmas now.
Definitely.
It's getting close to that time, isn't it?
Mhm.
Okay, thank you very much, everybody, and we'll hopefully see you all soon.
Thanks, Andrew. Cheers.
Thank you very much.